Did you know the banking system collapsed in September of 2019 and the Federal Reserve had to bail them out? Well, the mainstream media did cover it in 3- and 5-minute segments here and there throughout their newscasts, but it got buried in a lot of the other non-information that they were putting out at the time. Now remember, in the fall of 2019, we were 3 months or so before the coronavirus even was a name. It hadn't occurred yet. That didn't happen until around late November, going into December. We started hearing some chatter about it in China, but it wasn't really in the public stage a really big event. I'm Dave Deschesne, editor and publisher of the Fairfield Journal. I've been writing about the coronavirus since it became a story here in the United States in mid-March of 2020. Well, I just recently published an article in the July 1st, 2020 edition of the Fairfield Journal, which talks about coronavirus, the banking collapse, and how the government and media seem to have been working together in concert to mold and craft this story to provide cover for a banking collapse and ultimately a worldwide economic collapse that they can then blame on the coronavirus. Now, a lot of you out there have probably thought this, and you probably figured, I think there's something to this hype. They're really overhyping this coronavirus, which isn't really producing case fatality rates much worse than a really bad seasonal flu. Now, we're not going to go into all that in this video, but we are going to connect the dots. We're going to piece things together. We're going to talk about the banking system. We're going to talk about what happened in September, and we're going to talk about how it looks like the governments and media conspired together, either loosely or directly, to create a narrative that will scare the public, distract them, and redirect them, all the while participating in one of the largest banking bailouts in the history of the world. Now let's get to it. The global economy was set for a massive crash and reset last year, and predictions from leading economists were for it to begin by the end of 2019 into 2020. At the time, the dreaded and overhyped coronavirus COVID-19 hadn't even been thought of either locally or on the world stage, at least not publicly. Market forces from various sectors of the world's economy were swirling together to create the perfect storm. A storm which was being exacerbated by the international trade war with China, promulgated by President Donald Trump, and an untenable global debt level in the public and private sectors, with the U.S. leading the way. The United States was the first domino to fall in this global event, and it tipped in September of 2019, several months before the media's superstar COVID-19 virus was unveiled in China. On September 17, 2019, the U.S. Federal Reserve was asked by the banking system and financial leaders to step in to help secure the house of cards in order to prop up the banking system and prevent a catastrophic collapse. The Fed began pumping money into the system from September through December of last year, but the problem continued to worsen by the day. They continued their efforts through at least April of this year, but to no avail. Meanwhile, the COVID-19 narrative was being built and crafted by governments and their accomplices in the mainstream theatrical news media around the world. What we now know to be a virus with albeit horrible effects in the frail, elderly segment of society, but the fatality rate of a really bad seasonal flu and barely affecting children and young adults, was ultimately co-opted and used as a scapegoat for the collapse, a collapse that began months earlier from economic conditions which started brewing years earlier. Bailing out the banks again, not only in the U.S. but worldwide, since many other countries are in the same situation, would have been a difficult sell to the public, don't you think? So it appears the COVID-19 narrative was co-opted by governments and magnified in the mainstream media to be much bigger than it really was in order to create a pretext for bailouts to the public and business sector. These bailouts ultimately ended up in the banks where they were intended to begin with. But without the public outcry, since some financial breadcrumbs were filtered through the public's hands first. Ergo, blaming COVID-19 for the current global financial system collapse is akin to blaming an innocent passerby for a house fire, while the true arsonist sneaks away into a nearby forest. Well, how's that for an opener for the print edition of the Fairfield Journal? No other news media is going to cover it this way. That was just the front page, and that's what most people are going to read if they're standing in line at the checkout or they're scanning the newsstand. That's probably more than they'll read, but if they glance through it, they'll get an idea that there's something more to this COVID-19 hysteria than meets the eye. And maybe I ought to pick up a copy of this paper or go online to the website and read it for free, because there's no subscription required to view it online, and see what the whole backstory of this event was, and see if it doesn't make sense how it gets pieced together between the financial system and the COVID-19 hysterical media narrative. Okay. Well, I'm not going to bore you with all of the stories. Okay, there were literally dozens of news stories and economists warning of the dire conditions throughout 2019. And without wading through all the minutiae and the details and the technical issues in those economic stories, I'm just going to go through and we're going to look at some of the highlights by just reviewing the headlines. Okay, I'll give you a couple of sound bites, a couple of little clips where they're necessary, but we're just going to kind of blast through all of last year, from January, well, really winter of 2018, all the way through to the end of 2019 and into 2020. And we'll just see what the narrative was if you looked at the little 3-minute to 5-minute segments in the financial sector of either the mainstream media or the television news media. But remember, we were all talking about Trump and Russia collusion and all of that last year. So that was the headlines. That was the one story getting most of the attention in the media, but they did filter through their little economic stories, and if you happen to read them or you happen to see them on TV, I don't watch TV myself, you would at least have heard about it, but not had it pieced together for you. So that's what I'm going to try to do here. In 2018, the Financial Education Channel on YouTube was already looking at some problems with the global economy, which would be manifesting in 2019 and 2020, with a video entitled Global Economic Collapse Coming 2019. That same month, the New York Times published an article entitled, Are You Ready for the Financial Crisis of 2019? On January 5th, 2019, The Guardian published an article entitled Pessimists are predicting a global crash in 2020. In a March 6, 2019 article on newstatesman.com, the headline was, The Next Crash, Why the World is Unprepared for the Economic Dangers Ahead. Highlighting issues outside the U.S., Reuters published an article on April 12, 2019, entitled, Turkey's Economy to Contract in 2019, Longer Recession Ahead. Meanwhile, in the UK, the Metro published on April 30th, 2019, an article entitled, A Second Great Depression is Coming, and Recession 99.9% Likely in 2 years. Okay, so I've gotten you up to the spring so far of last year. Remember, COVID wasn't even in our vocabulary back then. Okay, this is all what was going on underneath the mainstream media hype stories of whatever Donald Trump was doing that day. But if you keep listening to the undercurrents, they are telling you something's coming, something's about to happen. It just wasn't getting a lot of traction in the media because, financial articles, let's face it, they're kind of boring, right? Until the collapse happens and then you're out of money and out of work. But don't worry, they're going to come up with a distraction later on in the year to shift your attention away from all of that. Now, in June of 2019, still just over a year ago, the South China Morning Post published a story entitled "Brace for Global Recession Unlike Any Other Amid a World Polarized by the U.S. and China." The article pointed out how the 2019 recession will be different in a, quote, heavily leveraged global economy with already slowing trade. So what that means is this isn't just a U.S. problem. This was an entire world problem. And the debt levels and the manufacturing slowdown, all of that was happening last year, really from 2018 through to 2019. And it was starting to gum up the gears in the world's financial system, but it was still moving along. People were still working. Unemployment was what, at an all-time low. Remember those stories last year? Well, the banking industry and the financial sector didn't have such a rosy outlook on the whole situation. In fact, Paul Weinstein from Promontory Interfinancial Network was interviewed by CNBC in June of 2019. In a survey of U.S. banks done by his group, he found the confidence index among bankers was dropping. Remember, this is June of last year. He said,
"It has been dropping quite consistently throughout the year. What comprises it is demand for deposits, loan demand, which has not really reached the levels that banks have expected, access to capital, access to funding. On all these things, basically banks are sort of becoming a little bit queasy about what's happening out there."
Domestically, the U.S. is in pretty bad financial shape. Despite the pre-COVID-19 roaring economy, the U.S. national debt currently stands at over $26 trillion. And there's nearly that much again in the private sector for debt as well. According to the Federal Reserve Bank of New York, total household debt in the U.S., counting mortgages, student debt, automobile loans, home equity loans, credit cards, and other debt instruments, was $14.15 trillion at the end of 2019. The St. Louis Fed listed state and local municipal debt at $3 trillion in the fourth quarter of 2019, and the U.S. Federal Reserve Bank noted a combined $8 trillion in corporate, industrial, banking, and mutual fund, as well as derivatives debt. And now this brings the total debt to around $51 trillion here in the U.S. That's not counting all of the unfunded government mandates like Social Security and Medicare and Medicaid and all of the derivatives that the Federal Reserve had to absorb since the 2008 crash. Well, this crash that we're in now is multiple times worse than that 2008 crash. According to the Fed, with all that debt now, according to the Fed, the gross domestic product of the U.S., which is all of what we produced for all of 2019, all of the service and manufacturing and the total gross sales, was only $21.7 trillion. Well, collectively between the U.S. and private debt and business debt, we had over $51 trillion. And we only had a gross domestic product of $21.7 trillion. Now, those kinds of conditions can't continue, and they're not. It crashed. But they dragged out COVID, and they got you distracted from that. Now, the U.S. debt isn't the only storm cloud on the horizon, since the situation is global. In an April 2020 documentary on CNBC, Sam Meredith explained the global borrowing system and how it's grown so rapidly.
Global borrowing has been growing rapidly, so rapidly that many are concerned it is quickly becoming unsustainable. The Institute of International Finance estimates total worldwide debt, which is made up of borrowings from households, companies and government, surged to a staggering $253 trillion at the end of September 2019. That's a whole lot of debt, more than 3 times the annual economic output of the entire world.
Meredith also described how there have been 3 waves of global debt increase, followed by economic collapse, since 1970. The world is currently in a 4th wave, and it's by far the largest. This one began in about 2010 with the quantitative easing introduced by the Federal Reserve Bank. But Meredith says,
the World Bank says we're currently in the midst of the 4th wave of global debt. And if we're to avoid history repeating itself yet again, Governments must make debt management and transparency a top priority. This wave of global debt is thought to share many of the same characteristics as the previous three, including prolonged periods of low interest rates and changing financial landscapes which encourage more borrowing. But the World Bank has called the current wave the largest, fastest and most broad-based of them all. It involves a concurrent build-up of both public and private debt, involves new types of creditors, and is much more global.
Even Democrat presidential hopeful Elizabeth Warren was quoted in a July 22, 2019 CNBC article saying, quote, "The warning lights are flashing for the next economic crash." 3 days later, Zillow.com issued a press release stating, "Next recession will begin in 2020. Again, this is the summer of last year. This isn't this year, this isn't the spring, this was a year ago. This is now 6 months before COVID-19 burst onto the scene in a super media frenzy. But cheer up, it gets worse. August of 2019 saw a flurry of news articles preceding the start of the global collapse. CNN reported on August 14, 2019 that, quote, 5 of the world's biggest economies are at risk of recession. On August 15, 2019, WBUR.org reported the global downturn has already begun, bracing for recession, where the U.S. stock market had its worst day of 2019. A day later, CNN Business reported a global recession may be coming a lot sooner than anyone thought. On August 19, 2019, BusinessInsider.com reported more than 70% of economists think a U.S. recession will strike by the end of 2021. This story was echoed by the Washington Post in an article entitled 3 out of 4 economists predict a U.S. recession by 2021, survey finds. The Atlantic published a report by Annie Lowrey on August 26, 2019 entitled "The Next Recession Will Destroy Millennials," which pointed out how millennials are already deeply in debt with no savings. In September of 2019, Joseph Stiglitz, Nobel laureate economist, told BBC Newsnight,
"And we are on the verge of a significant global slowdown."
Which countries do you think will be the most and least affected by that?
Well, Germany is already poised to go into recession, and that will weaken all of Europe. The United States is not likely to go into recession, but the promises that Trump made will clearly go to wins. He talked about growth of 4 or 5%. After the sugar high of his tax cut, we had 3.1%. We're already down to 2.1%. And then, of course, China's slowdown is pivotal in the slowdown of the global economy.
To what extent do you think the current uncertainty in the global economy is down to the White House, the policies of the man in the White House?
Very much so. The protectionism, the trade wars are clearly having global repercussions, but there's a broader problem. He's trying to redefine geopolitics in a chaotic way. Problems in India, Kashmir, in Iran are all related to the instability of Trump's foreign policy.
You've talked about the world going into a slowdown, particularly countries like Germany. What do you think it means for the UK?
Well, we live in an interconnected world where a slowdown in any country, significant country, has global repercussions. Britain is not insignificant, and the uncertainties associated with Brexit clearly are contributing already to weaknesses in the UK, and that will also have repercussions, especially for Europe, but then eventually for the whole world.
So what's the problem? Well, though headline US growth seems to be holding up so far, Donald Trump is plainly upsetting global investors and businesses. This shows how measures of trade policy uncertainty have been driven up sharply by the president's trade hostilities towards China. The same is true for economic policy uncertainty.
Again, this was in September of last year, now 3 months before the COVID-19 burst out onto the mainstream media's super stage, okay? Manufacturing was already beginning to stall in 2019. We had this ongoing trade war with China that Trump was engaging in. Everybody was threatening and increasing tariffs and anything you had to get from China, and a lot of it still did come from China and does come from China, had tariffs added to it, sometimes up to 20 to 25%. So the presumption in the public's eye was, well, China's paying those tariffs and we're getting them. Well, let me tell you a little secret about tariffs. Those get added on at the end of the line, which is just before the consumer. So when the distributor brings it in, they have to pay the tariff, and they add that into the cost of the products because, let's face it, businesses are in the money-making business, not the tariff-paying business. So they just added those tariffs onto the cost of the products, and the consumers here in the U.S. ended up paying them. China didn't pay those tariffs, but that's a digression. Now let's move into November of 2019. In a November 2019 Motley Fool's documentary on YouTube, it was noted,
the Institute for Supply Management releases its Purchasing Managers Index every month, which is a gauge for how the manufacturing sector is doing in the U.S. And in September, the PMI fell to 47.8%. That's the lowest percentage it's been since June 2009, and any reading below 50 signals a contraction. There's little doubt that the ongoing trade war between the US and China is the biggest headwind in this confidence collapse in manufacturing. Peter Bookvar, the chief investment officer at Bleakley Advisory Group, recently said that we have now tariffed our way into a manufacturing recession in the US and globally.
So manufacturing really was starting to slow down, and the warning signs were all over the place. Now let's go back to September, a couple of months earlier than that report was issued. On September 2nd, just 2 weeks before the collapse began, Fortune magazine published an article entitled, "Why the Next Recession May Feel Very Different Than 2008." On September 16th, as the collapse was beginning, Bankrate.com published a story by Sarah Foster entitled, "How Likely is a Recession by the 2020 Elections?" Here's what the top economists say. Then the shoe dropped. While 10-year Treasury notes were suffering under a yield curve inversion, the repo market, which is a pipeline of money that banks and financial institutions use to loan money to each other amongst themselves, that began to dry up, and the collateral used in those short-term loans, namely U.S. Treasuries, had seemingly fallen out of favor as security for those loans, pushing the interest rates for repo loans from an average of about 2% to more than 10% practically overnight. Well, this is a sure sign of a big problem when the banks don't trust themselves well enough to loan each other money, and they don't trust the U.S. Treasury well enough to accept it as collateral. So this was mid-September, before COVID-19. Again, I have to keep stressing this because everybody's brain is in this COVID treadmill right now. COVID-19 hadn't happened in the public eye yet. But I think maybe it was being worked on and brewed and created and crafted, the narrative at least, in the background outside of public view, in the event that they needed to drag something out to create a massive distraction. Now the collapse begins. There were several problems conspiring leading up to that fateful day of September 17th, 2019, that converged to produce the start of what governments worldwide are hesitant to admit: a worldwide, global economic collapse. In addition to the burgeoning debt loads around the world, some of the more immediate problems were being manifested right here in the U.S. as the banking system was teetering on collapse, as well as the U.S. Treasury system. Now, I just mentioned yield curve inversions real briefly, and you know, that's a pretty technical sounding term. Prior to the collapse, 10-year U.S. Treasuries were bouncing back and forth under what's called a yield curve inversion. Now, what is a yield curve inversion?
A yield curve inversion happens when longer maturing bonds have a lower yield than shorter maturing bonds. Generally speaking, short-term bonds should have lower yields than long-term bonds. After all, if you're giving up your money for a longer period of time, you expect to be paid more for doing so. But over the past couple of months, the 2-year and 10-year Treasury note swapped places a few times, with a 2-year note bearing a higher yield than the 10-year, which is known as an inversion. Every single recession in the U.S. economy since World War II has been preceded by an inversion of the yield curve. Although it's important to note that not all yield inversions have necessarily been followed by a recession.
Now, we talked about the debt a few minutes ago, but that is a big topic, and the debt to GDP is a problem, and bankers know it, economists know it. The general public doesn't seem to know or care too much about it because they're too busy living their lives or worrying about what the mainstream media is complaining about Donald Trump or whatever. But the debt to GDP issue was pretty big. Now, Treasuries, U.S. Treasuries, are essentially loans investors make to the U.S. government, and they maintain their value in the marketplace so long as the governments have the ability to pay them back, or the investors at least think the governments have the ability to pay them back. However, in 2018, the U.S. debt to gross domestic product ratio reached 110%. That means the U.S. government owes 10% more in outstanding debt than the entire economic output of the country for that year. That was in 2018. But it gets worse. When one considers the unfunded liabilities the government is also on the hook for, such as Social Security, Medicare, Medicaid, and other sundry government programs where they're giving away free money, the debt increases to nearly $80 trillion. This makes the debt to GDP ratio around 300%, or 3 times more than the annual economic output of the country. Now, we're just talking about the U.S. right now. Other countries around the world have the same issues, same problems. They've borrowed way more than their countries are able to produce, and pretty soon the music's going to stop and they're going to have to find a chair. And this was illustrated by Jeff Neighbors in his video on YouTube.
So out there in the general market, people are being told they should view treasuries as risk-free because they should view the government as having no chance of defaulting on its debt. Yet the government debt is much, much higher than is being published, and it is questionable. How are they going to pay this debt? We're not just having good years and bad years where the debt goes up and down. It just goes up and up and up. So one possibility is that the banks know something that we don't know about a government's ability or lack thereof to pay its debt, which is what's required for these treasury bills to perform.
Now, another reason banks may be viewing treasuries as too risky to take as collateral is because some of them don't actually exist. What that means is some banks have pledged their treasuries as collateral on another loan and are thus double dipping the collateral. The analogy would be like if you took out a home equity loan on your house for either the full value or nearly the full value. Let's say you tapped it out, and then you went to another bank, and without them checking on you, you took out another loan and repledged your house again as collateral. Now you've got nearly twice as much debt against that house than the house is actually worth. Well, that's what was happening in some cases in the U.S. Treasuries market with banks, and nobody knew which banks were doing it because it wasn't something that was kept track of very closely. So banks were a little skittish about how they were going to loan money to each other and at what rates. Now, these fundamental issues with U.S. Treasuries are important because Treasuries are the primary financial instrument used as collateral in what's called repurchase agreements, also called repo loans. Repo, a lot of people hear that and they think, oh, that's repossession. The banks are repossessing something. No, it's got nothing to do with repossession or taking collateral on a loan. It's a short or an abbreviation for repurchase. I don't know where they get REPO out of repurchase, but that's the banking system. That's what they do. So you have these repo loans where the banks would loan each other money and pay it back in a couple of days, kind of like a pawn shop. By some estimates, some banks have pledged the same treasuries as collateral on repo loans up to 3 times. Now, we're going to talk about the repo market here in a minute, but we're still getting through some of the problems that banks were having with each other. Now, banks that did have cash in many cases weren't allowed to loan it out due to the Federal Reserve regulations, which were required to keep more of it on hand. In a January 20th, 2020 article posted on NASDAQ.com, Colin Harper explained, Ironically, the cash crunch that necessitated the Fed's repo intervention arose from regulations that were meant to keep cash in reserves to prevent a run on the banks or other liquidity crises. Reuters, for instance, reported that bankers and analysts believe that J.P. Morgan, the largest bank in the U.S., may have had liquidity to finance these repos itself if it hadn't withdrawn 57% of its cash, or $158 billion from the Federal Reserve throughout 2019, and if new regulations didn't mandate stricter reserve requirements. Without enough cash in the bank to refinance the repos and satisfy these reserve requirements, J.P. Morgan was more reluctant to lend out what it had left. During this time, J.P. Morgan had the money, but it couldn't legally lend it out. So there, we've set the stage. Now we're going to talk about the repo market. Under the current fractional reserve system of banking, banks are only required to keep around 10% of their assets as cash on hand. The rest of it they can issue out as loans. However, if during the day too many checks or requests for cash have cleared at a particular bank, it'll end up being short of its reserve requirement. So in order to maintain that reserve level, the bank will then go to the repo market, and they'll pledge some of their securities, some of their U.S. Treasuries as assets, and they'll agree to repurchase them back in a day or two, sometimes up to 2 weeks. Depends on the agreement they make with the lending bank. Now remember, these are banks borrowing money from banks. These aren't people going to banks for a mortgage or a car loan. These are banks borrowing money amongst themselves. So they pledge the U.S. Treasuries as collateral, and they agree to purchase them back with interest in a given amount of time, usually very short. Then the lending bank charges a small interest fee, which the Federal Reserve likes to target right around 2%. Well, this process is in effect very similar to how a pawn shop operates. However, the banks aren't pawning television sets, home stereos, video cameras, and wedding rings. They're pawning U.S. Treasuries. So that Treasury has to keep value inside of that pool of banks, or the whole ability for banks to borrow money from each other to keep their reserve requirements and to do other financial shenanigans that they like to do. That would all come to a grinding halt very quickly. Well, what happened in September of 2019 is the banks were no longer as willing to lend their cash to each other, and they were getting skittish on the continued devaluation of U.S. Treasuries. This caused the repo interest rate to explode from around a Fed-recommended 2% rate to 10% in some cases. On September 17, 2019, banks that needed money petitioned the Federal Reserve to step in and loan it to them in the repo market at the Fed's 2% rate. This isn't something the Fed normally does. The Fed normally just allows banks to borrow money amongst themselves, lend it to each other, get them through those rough spots where they need a little extra cash, pay off the repurchasing agreement, get their U.S. Treasuries back, everybody's happy. So they've been doing that for years, and the Federal Reserve hasn't felt the need to come in and bolster that system. Well, when September 17th happened and the interest rate spiked to 10%, that made borrowing money between banks way too expensive. And the Fed agreed to help them out. And they initially started pumping in around $75 billion into that repo market. Now, that sounds like a lot to you and me, but $75 billion is really not a lot of money in this type of a market. Nearly a month after the crash, on October 14th of 2019, Bloomberg published an article stating in its headline, U.S. Recession Model at 100% confirms the downturn is already here. But this article was later revised on April 8th, 2020 to conform to the new COVID-19 media hysteria hype. The Guardian in the UK published a story entitled, World Economy is Sleepwalking into a New Financial Crisis, warns Mervyn King. So we have the repo market collapsed September 17th. We have the Fed coming in, promising to bail them out and bailing them out, giving them that money, giving them those short-term loans. And the financial sector of the markets is noticing that. The news media is noticing that. Again, we had Trump story after Trump story, a Russia collusion, whatever it was in the cycle at the time, that time last year. Remember, this is fall of last year, 2019. COVID still wasn't an issue. COVID wasn't even presented to the public yet. Nobody knew about it. Nobody was worried. Everything was good. We had great unemployment numbers. Everybody was working. Everybody's making money. But this stuff's going on in the background. And the economists and the bankers at the top, they knew what was happening, and they had to figure out a way to put some controls on it so it doesn't get out of hand. Well, in December 4th of 2019, omfif.org published an article by Desmond Lackman entitled "Signs Point to Global Recession." At this point, a new type of flu virus, that COVID-19 that everybody's now so worried about, was just beginning to surface in an obscure province in China. And media attention was still focused on the presidential race and whatever fictitious crime they could pin on President Trump in their 24/7 coverage. A couple of months later, they started giving COVID-19 a little bit more attention in the midst of perhaps the largest global meltdown in the history of the world. But not a word about that. No connecting of the dots. No mainstream media interest in this global collapse outside of the few 3 or 4 minute little segments that they put into their financial section of their channels, which very few people actually ever watch. However, that fact was not lost on me. And I did publish an article in the April 22nd, 2020 edition of the Fairfield Journal. It was entitled "Corona Scam Plandemic: How Governments Exploited Coronavirus to Camouflage an Economic Collapse and Pre-Sell Mandatory Vaccinations." What was supposed to be a temporary fix until the repo market calmed down ended up lasting for months. By the end of 2019, the Fed had extended $500 billion into the repo market. By April 2020, they had agreed to provide another $500 billion. So let's do the math, kids. That's $500 billion plus $500 billion. The Fed had pumped $1 trillion into this repo market by April of this year. And they didn't feel like that was enough. They had also ramped up purchases of U.S. Treasuries to allow the now bankrupt U.S. government to continue borrowing money to pay its bills. Now, propping up the repo market was understood not to be a permanent fix. It was merely a stopgap measure until something could be done to increase liquidity. That means to put more cash into the banks. That would have come as a taxpayer-funded bailout, similar to the quantitative easing debacle the Fed did in 2008-2009 and after that crash. However, how well do you think the public was going to accept another banking bailout? It was going to be a hard sell to the public. They were already growing weary of the Wall Street banks getting bailouts and the stock market getting bailouts. So the Feds had to figure out a way. Let's see, how can we effectively market our bailout plan to gain the maximum amount of public support while at the same time deflecting the attention away from the bailout? Well, a very clever theatrical media marketing plan was developed. I don't want to say necessarily it was in collusion with the Feds, but let's face it, at that level, at the top level, they kind of really all do work together. It's like a big World Wrestling Federation or World Wrestling Entertainment event, spectacle. And they work together, the Feds and the media, to mind screw the American public. So what was this theatrical media marketing plan, you might ask? Well, I submit that it was COVID-19. So here we have Act 1. Cue the coronavirus. He enters on stage left. Raise the curtain. And bedazzle the audience with smoke, pomp, and viral flair. By March, COVID-19 was on the fast track to becoming a media superstar. The mainstream theatrical news media's marketing division went into overdrive, selling the fear on the coronavirus COVID-19 under the guise of, quote, news. Well, the government mandated lockdowns, face mask mandates, and social distancing of 3 feet, 4.5 feet, 6 feet. It varies by the country, you know. Kept the population off balance. Then they didn't really have the ability to focus on anything but the 3D reality TV virus show that they were all immersed in. Courtesy of the mainstream theatrical news media, continuously pushing the government narrative while also incessantly hyping the death numbers. And you remember hearing about it day after day after day after day. It was so many thousand dead here, or so many thousand dead there, and we have all these nursing home deaths, and it was just death, 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 death. That's all the media wanted to talk about, because they were building a narrative to scare the people in order to deflect attention from something else that's going on, and then get the people's tacit approval for what would eventually be a banking bailout. Well, we're finding now that the numbers that they were spewing were dramatically overcounted by many governments' health departments in order to keep up that political facade. The public, petrified with fear by a novel flu virus and out of work potentially for months due to mandatory government-inspired lockdowns of nearly the entire business sector and economy, was easily cajoled into, quote, accepting the banker bailout in the form of a personal check written directly to them. That marketing scheme is what was known as the Payroll Protection Plan, where everyone in the U.S., or nearly everyone in the U.S., received their own personal check for many people up to $1,200. Some people, depending on their income level, it went down maybe $500. But between $500 and $1,200, many unemployment workers also received subsidies of $600 per week in order to voluntarily remain unemployed and stay home for months. Then businesses applied for billions of dollars worth of ostensibly forgivable loans, providing they didn't lay off workers while they were shut down. Now, I'm just going to digress for a minute. Some of those businesses took out loans. I can think of a few here locally, where the loan would be forgiven as long as you keep your current staff on payroll. Okay, that was the idea of the loans, so nobody would have to go without a paycheck. Well, the businesses marched down to the bank like they were told to do. They took out $100,000, $150,000 loan, and then they started paying their employees. But then along comes the $600 a week unemployment, and all you really needed to do to claim that was say, well, I'm afraid for my health because of COVID-19. I think I want to stay home. And you could cash in on that unemployment. Well, most businesses aren't able to pay the $600 a week that the employees were going to get from their unemployment. So the employees, many did, opted to stay home and collect unemployment after their boss, their business that they worked for, had already borrowed the money that was the loan would be forgiven. That means the business wouldn't have to pay it back if the employees stayed employed. Well, the employees didn't stay employed. They stayed home on unemployment. So the business now cannot comply with that particular part of the agreement, which said that they would have to keep their people on the payroll. So now many businesses are being stuck having to pay back that loan. And I saw that coming, and nobody wanted to listen to me. I saw that coming. I said, there's these free loans. Many businesses are going to have to pay them back. And as it turns out, that's what happened. And that's what's going to happen as the loans come due, is these poor businesses aren't able to comply with the keeping people employed because they were competing with the federal government giving people money to stay home on unemployment. So leave it to the federal government to take something simple and make it complicated and make it worse. But I digress. Let's get back to the topic. All of this money, all of the payroll protection money, all of the business loans, Small Business Association, quote, forgivable loans, those were all issued at once, $2 trillion all at once. And as people and businesses cashed those checks and spent them, the money ended up where it was originally intended to go, to the banks. What a clever scam. Well, this sleight of hand pumped more than $2 trillion into the bank in less than a month's time. And it could never have been achieved without the assistance of the COVID-19 virus and the fear generated about it in the mainstream theatrical television news media. The non-living virus particle unwittingly lent its persona to the governments of the world, as most of the other governments commenced with similar economic stimulus programs in their own countries. And this was in order to shore up their own banks, which were also in trouble. In a June 21st, 2020 CNBC article by Hugh Sun, the headline reads, U.S. banks are swimming in money as deposits increase by $2 trillion amid the coronavirus first hit. In the article, Mr. Sun points out how in April alone deposits, quote, grew by $865 billion, more than the previous record for an entire year. Meanwhile, the U.S. taxpayers, elated to have received the $1,200 pittance, failed to realize they were unwittingly helping the government launder the banker bailout money into the banks, and barely a cry of protest was heard. Well, this clever tactic was beautiful enough. It was the crowning achievement of a sophisticated government prowess, coupled with an even more sophisticated mainstream media, theatrical news, propaganda marketing industry. But now that the banks have been covered, there's still a worldwide economic collapse to own up to, with manufacturing shutdowns, food shortages, personal debt, and business debt still raging like an out-of-control forest fire around the globe. Now, rather than admit it was government and financial system mismanagement, the marketing arm of government and media went back to the spin cycle for Act 2 and rolled out the coronavirus COVID-19 boogeyman once again. This time, to blame all of the world's financial crises on it, thereby shifting the blame and attention away from the real perpetrators. Now, for those of you who've read Orwell's 1984, I suspect a few of you out there have, you remember that the boogeyman in that book was Goldstein, where everybody's attention was diverted to Goldstein whenever the government wanted them to be mad at something in order to deflect their attention away from what was really going on. Well, for today's purposes, it's not Goldstein. It's COVID-19, and COVID-19 is doing quite nicely for the feds. Now here we are a year after, more or less a year after the economic collapse was predicted, and it's happened. But nobody knows about it outside of the context of the COVID-19 lockdown narrative. And that's, not by accident. Looking at some of the media headlines today, we see the narrative has been completely co-opted across the board by coronavirus COVID-19. On April 9th, 2020, the BBC published a report entitled Coronavirus, Worst Economic Crisis Since 1930s Depression, IMF says. But that release may have been a timing error since the International Monetary Fund didn't publish that report online until April 14th. On May 11th, 2020, ScienceDaily.com published an article entitled, How is COVID-19 Affecting the Global Economic Order? Reason.com reported, the COVID-19 economic collapse is absolutely wrecking state pension systems. On June 8th, 2020, WorldBank.org published a story entitled, COVID-19 to Plunge Global Economy into the Worst Recession Since World War II. And the list goes on and on and on. Now every time the public hears economic collapse in the news, it will be dutifully blamed on COVID-19. But was COVID-19 really the root cause? Or was it just a passerby conveniently there to lay the blame on?